So India's Q2 GDP numbers are out. To tell us more, I'm joined in by my colleague Snehi Shah. Snehi, tell us more. How do the numbers look like?
Excellent set of numbers coming in, Shivani. That is the first reading on the numbers. If you take a look at the numbers, it's coming at 8.2% on a year-on-year basis. The street estimate or the Bloomberg consensus was at 7.4%. Here at ET Now, we had built in a poll of 7.3% with a target range of anywhere between 6 and 8.5%. This number that's coming at 8.2% is in fact towards the upper end of our band. So looking very good. That's the first initial take coming in. GDP at 8.2%. Let me take you through some of the more numbers that we have that are just trickling in on the wires right now. The GVA addition has come in at 8.1%, gross value added, looking healthy over there, beating an estimate of 7.3% as well. And remember, this is the third or fourth consecutive quarter, in fact, where we have seen the number come in above 7%, and this time around the number has come in above 8% as well. So how sustainable is that? We'll be getting into an interaction with our economists and experts on the show in about a minute. Before that, let me tell you what some of the numbers are. The farm growth has come in at 3.5%. Mining growth, a slight blip, but very, very nominal blip coming in, almost a flat move on the mining growth number. Manufacturing growth looking healthy at 9.1%. Power and gas have done okay at 4.5%. You have telecom growth of 7.5%, so looking good over there as well. The construction growth has come in at 7.2% on a year-on-year basis. We also have the fiscal deficit number that's just trickled in, and the deficit has reached 52.6% of the total FI target. So let's make sense of all of these numbers that have just trickled in. To do that, we have Ms. Aditi Nayar, the Chief Economist at ICRA, Garima Kapoor, Economist and Senior Vice President at Elara Capital, and Debopam Chaudhuri, the Chief Economist at Piramal Finance, joining us on the show. Thank you everyone for your time, and let's start with you, Aditi. Your first take off the bat of this GDP number, better than our and the Bloomberg consensus estimate. Has it beat your estimates as well?
Oh, absolutely. I think, now this is the second quarter where we got an initial GDP growth print, which is much higher than what the consensus was. We were at the lower end of the range this time. We had a GVA growth forecast of 7.1% for this quarter, and it's actually come in at 8.1%. So, large deviation as compared to our estimate. And I think the main reason for this is the services sector. So while agriculture and industry are in line with our forecasts, the service sector growth has come in much higher than what we expected. Which is a little surprising given the fact that we did see quite a bit of slowdown between Q1 and Q2 in the growth of government expenditure, which was one of the main reasons why we thought that the service sector growth was going to slow down. So yes, definitely much higher than expected. And we'll have to see again, we'll have to revisit our forecast for H2 in light of this average 8% growth in the first half of FY26 to really understand going ahead between the competing sort of impacts of the trade uncertainty and the GST buoyancy, how H2 is likely to pan out.
A revision on the positive side, on the upside, it's sounding good going ahead for the economy. Garima, weigh in over here and talk to us about what you have made of this number, if you are going to be making any changes on the upside to your overall FY26 GDP target, and also the sectors you think have led to this kind of growth. Has it largely been on the basis of the agriculture economy?
The number is really a blockbuster. So, of course, the full year number that we have, which is already above what RBI's own estimates are, will have to be revised upwards, because you'll now be tracking, even if you assume and take into projection the quarter four to be somewhat softer than quarter three, because you will have some moderation of the front loading of exports, plus some impact playing out in terms of uncertainty relating to government spending, as your normal GDP is going to be weaker. Yet your full year numbers will probably now track a number close to 7.4 to 7.5%. That will be like way above even the higher estimate that the government, that the CA had itself put out in the early part of the year. Now, a significant part of this growth is driven by manufacturing, because there was a front loading of exports. Remember, when you had anticipated a deadline for tariffs kicking in, a lot significant, particularly your goods exports had seen a front loading. Second, there is a front loading of government spending, where particularly capex growth has seen a robust 40% year-on-year growth. That all factors are indicating that a significant part of this growth has been led by somewhat one-off factors that may or may not play out in the next quarter, but so third quarter certainly have a significant impact of GST-led consumption uptick that will play out.
Yes, thanks for that take. Debopam, talk to us about what this means for the RBI action that we're going to be seeing towards the end of next week. Inflation numbers have been better than expected this time, and this time the GDP number also has been much better than what the street was estimating. Does that warrant a rate cut? Does that make up for a case for a rate cut now?
5 minutes ago, I was like very confident about a rate cut, but with the GDP numbers, I hope the RBI doesn't take this too seriously, and the MPC doesn't consider this to be a significant signal regarding the fact that economy has come out of all the problems of COVID, which it has not done, certainly. So I still hope there's going to be a 25 basis point rate cut in December. And listen, the reason is very simple. Private capex is still in a very slow growth track. Okay, so only in the current quarter we have seen early signals of some risk taking improving compared to where it was in the last couple of years. We are seeing bond market issuances rise for sectors like chemicals, for sectors like manufacturing, particularly electronics manufacturing, as well as food processing. These companies are turning out to be major issuers in the bond market, and the appetite is also developing. But everything is hinged on the fact that the interest rate cycle, there's more room for the interest rate cycle to go down from where it is right now. So any shock or any surprise to that may impact the overall private capex cycle that we are so desperately waiting for. And that, as I said, this can become a little disrupting for the future growth prospects of the country. Secondly, the growth numbers are all very fine, and as Garima was also mentioning, and Aditi also alluded upon it, a large part of it is coming from the services sector, which is about 60-65% of our GDP. So that's the GDP is well taken care of. But remember the other part, the traditional segment of the GDP, which is seeing some growth, but acceleration is not there as much as the acceleration is there in the services sector, hires about 65 to 70% of our workforce. So at a time when we are going through this fantastic demographic dividend phase with more millennials and Gen Zs than baby boomers and the Gen Xs in the job market, it is very important to create more avenues to absorb semi-skilled Gen Zs and to a great extent many of the millennials, so that the job market keeps on being a major contributor to economic growth, particularly for this traditional segment of the economy, which may not contribute as much to the GDP, but creates a lot more jobs for the society, which usually have a very significant trickle-down effect on consumption. And then again, consumption is 60% of our GDP. So for this growth to be sustainable in the future, I think the rate, the capital cost incentive needs to be further strengthened. Capital cost needs to come down, private capex needs to pick up, and traditional sectors needs to strengthen much more than where they are today.
My question to you, Aditi, is that in the current GDP growth, where do you see the contribution of urban versus rural? And how do you see that shaping up going forward?
So interestingly, when we look at the expenditure side data, we've got yet another quarter of consumption growth, private final consumption expenditure growth being above 7%. We did expect that with the GST related boost that we got toward the end of this quarter, that we would end up seeing a good consumption number. And we have to see how this sustains going ahead. So if I look at urban versus rural, I think rural has been doing well in the last few quarters, and certainly this year's monsoon, although by the end of it there was a little too much of rainfall, but otherwise, when we look at agri sector indicators broadly, they are projecting a pretty rosy picture, and the reservoir levels have also been very good, and the rabi sowing has kicked off in a very timely manner. And overall, so far, at least the farm part of the rural economy looks like it's going to be able to sustain its consumption. On the urban side, we got a lot of positive policy support this year. We got the income tax cuts, we got the GST rationalization that came in later. We've already got 100 basis points of rate cuts. And whether we get that final 25 basis points or not next Friday, I mean, we're still waiting to see. So urban consumption in aggregate should do better going forward. Definitely on the GST side, I think it's not going to be a one size fits all across different sectors. The festive season saw a lot of pent-up demand for consumer durables coming through, including for really big ticket items like the auto sector. While I would expect that there will be a bit of a break from the very large ticket consumption after the festive season, the restocking will probably continue for the white goods. The auto sector, maybe because they were anyway sitting on very high inventories, it may not be as much of a positive volume impact going forward. And consumer durable, non-durables, I think will see an uptick a little bit later once people really reassess how much their household budget can stretch now. And overall, I also think that it's going to be a story of premiumization in many categories. So not necessarily volume increase for bigger ticket items, but definitely a story of premiumization going ahead. So I do think that the urban consumption patterns or the urban consumption sentiment should be better in the post GST period. One caveat, of course, is the sectors, households that are dependent on export-oriented sectors where there's a lot more of uncertainty because of what's happening with the US tariffs, etc. There, the GST is only going to be a minor palliative. It may not really be able to spur consumption because there'll be more of stress in terms of job security and things like that.
Point taken, and thanks for that wonderful breakdown. But Aditi, Garima and Debopam, stay on with us. We'll slip into a very short break and be right back to talk more about these numbers and decode them better on the other side when we return.